Welcome back. You're watching Trading Hour. It's time now to take stock of where the markets are headed. How should you construct your portfolio? Chirag Mehta from Quantum AMC is now with us on the show. Chirag, great to have this conversation with you. Welcome to Trading Hour. Wanted to first talk about the auto sector. Today, of course, Maruti is higher in trade. But in your latest note that you've shared, you've indicated that you've paired some of your positions in auto names in the month of June. Why is that? What is it that you expect from the autos? And in autos, break it up, right? There's two-wheelers. In the entry level, there is going to be increased competition with Bajaj Auto CNG launch. There is this Maruti news. So tell us what you expect for the various segments.
Sure, Rima. Thank you for having me, firstly. And within the auto, what we are seeing is, there are strong tailwinds for the sector overall. So growth is there, but what's happening is valuations have run up so much. We have seen a good rally in many of these stocks. And given the rally and some normalization expected going forward, because if you look at from a demand standpoint, what we have seen is more like a replacement demand kicking in rather than the new demand drive being driven because of more spending happening. So rural is still struggling. Probably budget will address some of the issues that we see in the rural areas. And even if there is some growth that is expected because of the budget, much of it is already priced in the stock markets. So overall, there is growth, there is tailwinds for that sector. The sector is doing well. We do like that sector from a growth standpoint. But certain names where we have seen a big run up in valuations because of stock markets running up, we have trimmed those positions to some extent. But overall, we do still like the auto and auto ancillary as a sector across our portfolios, be it the large cap portfolios or be it the small cap portfolios where we have more auto ancillaries in the portfolio. So we do continue to own many names in that space. But certain names where we thought that run up has been much more than justified by the valuations, there is where we have trimmed certain positions in that sector.
Chirag, good morning. Thank you for joining in. I'm sure you must be speaking to hundreds of your clients who may be asking you where should one invest. I'll flip the question a little for you. There are sectors where you should not be at this point of time. You mentioned that you should be tempering return expectations because there are plenty of sectors that have rich valuations. Which are the sectors that one should avoid at this point of time? Because sectors are seeing stocks double in a month. You would always have that valuation concern, right? Which are such sectors?
So certain sectors, it is easy to put a blanket out there and say that, these sectors need to be avoided, but the rally or the stock market positioning is getting more stock specific as opposed to a sectoral thematic that was going on for last year or so. So power as a sector or industrials as a sector has become expensive. Having said that, there are certain plays even within that which has great tailwinds, which has a great runway from a growth perspective, and valuations are still reasonable in those spaces. For example, when I say niche spaces, it's something like, for example, the smart meters in the space of industrials, where we still see some comfort, some runway for growth expected going forward as energy efficiency becomes a paramount need. We are seeing some great tailwinds for that sector. So certain sectors, as I said, industrials, power, etc., from a overall perspective, look pretty expensive from a valuation standpoint. However, there is growth support of it, but valuations have moved beyond what justified by the growth. And hence, those are areas where we are not venturing as much.
So when cash comes to you, where are you deploying it, Chirag?
So within these sectors, we still are comfortable with valuations in the financial space. So private banks is where we find some comfort on a valuation standpoint. Also, some insurance names is in the BFSI space is what we like. So those are the big areas where we are deploying cash. IT to some extent, we were buying all through. But now even there, we have seen some run up from a valuation standpoint. Though we are not trimming anything there, we are holding on to our allocations in the IT sector. So predominantly, it is finding out more bottom-up ideas. Some spaces in the material space are looking still comfortable from a valuation standpoint. like what's happening in the cement sector, we are seeing some plays there which are looking attractive, which have not run up as much from a valuation standpoint, and hopefully growth will emerge as we see more activity from infra and building construction space. We will see some tailwinds coming for that sector as well. So overall, BFSI is where we find some comfort, followed by IT to some extent, and some niche plays or some bottom-up ideas in the material space is what we are looking at.
Interesting. By the way, some flashes on your screen. Metropolis has shared its first quarter update, and they're saying that they are now debt free and now have a cash of around 140 crore on their books. The first quarter revenue up 13% on a year-on-year basis. The stock now surging to the highest point of the day at 2071 at Metropolis. Their True Wellness and bundling segment also now has become the fastest growing part of the company. So a healthy update there for the quarter for Metropolis. Now, Chirag, since we are on the subject of Metropolis, not the stock in particular, but this entire diagnostic space, that was the hotspot, right, during the COVID times, because they were surging, the testing was surging. But now with growth levels starting to normalize, there is still this bit of valuation discomfort because there's still some of them are still trading at a premium to their historical averages. Do you find any valuation comfort within this diagnostic space? And if you can couple that up with the broader healthcare space as well, say the hospitals or the drug makers as well.
So yes, in the diagnostic space, of course, there is a big runway on a long-term basis for growth. But the competition intensity in that sector is pretty high. And as you rightly pointed, that valuations are still not very comforting in that sector. So we are staying away from that sector at this point in time. But within the healthcare space overall, we like the hospital space. So in the small cap fund that we have, we do have exposure to certain names in the hospital space. We think that there is underpenetration in terms of the availability of hospitals, etc., that we have here. There is a lot of capex happening, and probably the fruits will be there in next couple of years. So from a longer term perspective, 2 to 3 years out, I think that space looks appealing to us. So we do own some names in the hospital space in our portfolio. But in the diagnostic space, we are observing that keenly, but we don't have much exposure to that sector.
The company Metropolis in their Q4 conference call had guided for revenue growth in FY25 to be in mid-teens with a focus on core business growth. So in Q1, it's come in at about 13%, but their guidance for the full year is mid-teens. And they're hopeful about sustaining Q4 margins at close to about 25.5%. The cash level as of Q4 was about 117 crore, and that has gone up to levels of 140 crore. It was debt-free even in the March quarter. It's still debt-free. The cash levels, though, have gone up from 117 crore in the March quarter, now I think to 140.
140 crore.
140 is now the latest update in terms of the March quarter. 13% top-line growth, pretty decent for the company. Chirag, you spoke about IT, that how you were bullish, but now you're concerned about the recent valuation, but you're not looking to at least pare down your holding. In IT, are you talking about IT services, or is it the engineering R&D company, the product companies like your KPIT, Tata Elxsi? Is there any stock right now in IT where you're still comfortable buying ahead of Q1 numbers?
We are not adding to our positions much in that space, but we are holding on to our positions in that in the IT sector. It's more to do, if you see, we are on the cusp of, say, a rate cutting cycle, which could start maybe 3-6 months down the line. And if there is uptick in discretionary spend in the US, then probably, the IT companies will kind of benefit because of that. So, and the AI space, I think they were seen as headwinds, but we have seen time and again that these IT companies use any such technological changes to their advantage and gain more business. So we are hoping that IT companies will use that at our advantage. We are seeing training, etc., or skilling in that segment from the IT companies is picking up significantly. So we are holding in anticipation of more business coming or growth coming in the IT sector, maybe another 6 months, 1 year down the line. So we are hopeful for some growth. So we are observing that space. If there is a reason to add, we may add further. But at this point, we are staying put with our allocation in that sector.
Chirag, thanks a lot for sparing time and joining us to share your views on the sectors that you are bullish on and you are not so bullish on as well. Chirag Mehta there from Quantum AMC. Time for a short break here on Trading Hour. More on the markets and specific stocks on the other side. Stay tuned. We'll be right back.